Marcus, it's pretty tough being a trustee at the moment. You've got money to invest, bank interest rates are low, the share market's all over the place, commercial properties through the roof in terms of value. Should I just put my money under the pillow, under the mattress?
Well, that's a very interesting analogy. I was going to say there's been a few sleepless nights, so maybe a pillow is actually a good idea. It's an extremely difficult environment at the moment, as both of us know. And when you're dealing with like a trust and like quite a lot of portfolio assets and so on, it's you're scratching your head all the time in relation to what do we do? Are we doing the right thing? And
so what's the most important thing in my mind, and what most clients forget? Most clients work really hard to save their money, but strange enough, most of them want to go and gamble it all red and black and try to make more. To me, the most important thing is return of capital, not return on capital. That's why we're seeing negative interest rates in Europe. You're going to get back 98% of what you put in. Great. You're actually going to get that much back. There's no downside risk or limited downside risk. So it's a really weird market, isn't it?
Well, it certainly is. And, and there's as you've said like a number of times, there's so much cash sitting out there waiting for a place to invest. What are people looking at? Hedge funds, kind of emerging markets, all those things and so on, which we've investigated and so on, don't necessarily work either.
And look, the markets will create a correction one day. We know that's going to happen. But what people have to remember is, what's their investment horizon? Am I investing short term, in which I probably shouldn't be in the markets, or is this intergenerational? In which case we just ride it out. The biggest problem in 2007 was that actually most people took their money out at the bottom of the market and then didn't ride it back up. Those that rode it out were back where they started within 18 months.
Yeah, correct. And it's a very important point that people miss in relation to investment strategy is, taking a long-term view of things, especially if you've got like a pool of wealth sitting there and so on, which is for the benefit of a family over a number of years. Yeah. You can't act in a knee-jerk type of situation.
And the other thing is, maybe if you've got different investment horizons, you break your fund up into different pieces. The shorter duration stuff is more income-focused and less risk. The longer duration stuff is more growth-focused. Look at the New Zealand Super Fund. It's got an investment horizon of 50 years. It's thinking 50 years out. Most families can't think 2 years out.
That's right. And for the New Zealand Super Fund, that works.
Yeah, it does.
Yeah, and every family is going to be different, and we have to consider that.
So it's going to be interesting times, isn't it?
Definitely.